Welcome, everybody. Today, Madison is going to be running a session for us on a use case specific narrative. This is going to be the start of a couple of episodes where we talk through a specific case. It's really exciting because we're going to be continuing with our spend personality narrative and applying it to something tangible that we can then take home. Madison is very keen on interactions from everybody, so please feel free to drop messages or questions in the chat during the session. And Maddie, are you good with everybody speaking out during the presentation? Cool.
Yeah, that's perfect.
You guys can just turn your mics off and hop in if you've got any questions to ask or any comments. Without further ado, Maddie, if you can take it away, welcome.
Hello, everyone, and welcome to today's meetup. This is a use case I've been working on for quite a while, and I'm excited to present it. Today, we are going to be looking at how banks can activate credit cards using spend personalities. To begin with, I kind of wanted to do just a credit card 101. I'm sure everyone here either has a credit card or is familiar with the concept of what a credit card is. So to jump into what they are and how they work. Essentially, a credit card is a revolving credit facility that allows customers to borrow up to a set limit. So you get allocated, let's say, $10,000 on your credit card. You can spend that $10,000 and then you have to pay that back to the bank within a set number of days. There is typically a grace period, usually about 30 days, where you can spend that money and pay it back in full interest free. If you fail to pay it back in full, for example, you spend the $10,000 and you only pay $8,000, you will then pay interest on that $2,000. In a nutshell, you spend on the credit card, the bank pays the merchant, you pay the bank back. If you don't pay them back in time, you pay interest. So understanding how they work, we now also want to understand the different ways that banks can make money from credit cards, but also the cost that is associated with issuing credit cards. So obviously, as I've mentioned, there's interest. There is also interchange fees. So anytime you tap your card at a store, the merchant will pay a percentage back to the bank from that transaction because of the point of sale and the cost of processing all the money and the transaction itself. The merchant pays that back to the bank. There's also annual fees, cross-sell opportunities, and upsell opportunities. For my bank, you have to have an account with them before you can open a credit card account. So you go from just a basic transaction account where you have a debit card, and then you upgrade and you get a credit card. From there, once you've been spending on that, the bank can then upgrade you to an even better credit card. Let's say it's a premium one as opposed to a standard one. They can also then start selling you different products such as savings accounts, investment accounts, and other types of credit facilities such as loans. Now, looking at the cost components. One of the ones I want to focus on is the cost of capital, or the unused limits and funds that goes into a credit card when a bank issues a credit card. The cost of capital is the money that a bank has to set aside for every person that has a credit card and the amount that they have been set on that credit card. So, for example, if a bank has, let's say, 10 customers that have credit cards, and each customer has a set limit of $10,000, the bank has to keep aside $100,000 in anticipation that every customer will use their set $10,000. The reason this becomes costly is because, number one, not only do they have to have that cash and that capital available, but not every customer will use that full limit. Some customers may spend $7,000, some customers may spend $5,000, some customers may not use that limit at all, but the bank still has to keep that money set aside in anticipation that they will. And what that means is that the bank isn't using their money to make money. They aren't investing it, nor are they earning interest on it. It is just sitting as cash set aside for customers to use. And that's where it can become quite costly. Then secondly, we also have fraud, operational expenses, and transaction processing. When a customer spends on a credit card, they are spending the bank's money, and you can guarantee that the bank's money will be protected, it will be insured. There are steps and procedures to ensure that if a card is stolen, if a transaction is fraudulent or something goes wrong, there are processes to ensure that it can be recuperated, insured, and protected. And that costs money to put that in place. There are also operating expenses, and same with acquisition and marketing costs. To get the customer, you have to market to them, you then have to acquire them. That has a whole set of operational expenses attached to that. Once they've converted and they're interested, you then need to onboard them, prove them as worthy of taking out a credit facility. You have to review their documents and ensure everything's in order and in place. You also have to open the account and manage the account, and that has costs attached to it. Then, as I mentioned, there's the transaction processing. So anytime you tap at a merchant, There's procedures in place for allocating money, the processes, and the costs attached to that. And then I also want to talk about the credit losses. When you get the credit card and spend your $10,000, if you fail to pay it back in full, you start paying interest. And if you don't pay that, either the $10,000 or the interest, you default on your credit card loan and go into bad debt. The reason this is incredibly costly for the bank is because you've borrowed their money and haven't given it back to them. But on top of that, they now have to go through the process of recuperating those costs. Money on one of his credit cards, I think he owed something about 26 Rand to a bank. The bank phoned him every day until he repaid that 26 Rand. The airtime fees and the fees that it cost or that they had to pay to make those phone calls and then be on the phone with Jay, it ended up costing them more. Jay calculated that, I can't remember exactly, but they paid more to get that 26 Rand back than if they just let it go. So these are the different ways that a bank can make money, but also the ways they have to spend money when it comes to issuing a credit card. So now if we unpack the different benefits to a bank issuing a credit card, but also the benefits that a customer can experience when they open up a credit card account. So there are steady revenue streams, but another important one is customer retention. With my bank, you have to already have an account before you can open up a credit card account. Once you've opened up 2 accounts, you build a stronger rapport with your bank and are less likely to leave. The bank is more likely to retain you as a customer. With that comes more cross-sell and upsell opportunities. I find customer retention and rapport building with customers so important because it feeds into brand principles known as brand stickiness or brand loyalty. And I'm a big fan of these because I do think they are a hidden strength to a bank, a kind of hidden asset that doesn't necessarily show up on a financial statement. Because we spoke about it a few weeks ago, with digital banking becoming so prevalent, and it's so much easier for customers to now chop and change and be onboarded and open accounts with different banks, it's also becoming cheaper. What is the strength that a bank has that keeps their customers with them and reduces that churn? That is brand loyalty. It is that relationship that a bank has with their customers that protects them. Now, if we turn to why customers benefit from credit cards, I'm a young adult and I've had to learn about credit history and what it means to get a credit card. And I, for so long, had this view that a credit card means debt. You do not want to fall into credit card debt. It's a trap. You don't want to go into it. It's something you do when you have a hold of your finances. But when you actually come to understand credit cards and how you can make them work for you, you see that it's quite a beneficial tool. So, number one, looking at convenience. Credit cards offer flexibility and convenience to customers because you have both funds available to spend freely. You have your income, which you get every month, let's say it's $10,000, but then you also have that credit card available, that $10,000 from the bank, which you can spend freely. So in the instance where an unexpected cost arises and you don't necessarily have the cash or the capital to pay it off straight away, the credit card gives you the convenience and flexibility to do that. It also allows you to manage your short-term and long-term expenses. Sometimes it's easier to pay for something in bulk early on and pay the full amount than it is, and it's cheaper than it is to pay it off in installments over a longer period of time. But the hassle of that is you need the cash and the capital instantly, and the credit card gives you the flexibility to do that. On top of that, there's also this idea that when you spend the bank's money, you keep your money and you can use that money to invest and earn interest on it. So you keep your money aside, you earn interest, you can then pay off what you owe from the bank. When you've spent below your means, you just pay it off interest free. And then there's also this layer of purchase protection because you are spending the bank's money, it is insured, it is protected, and there are procedures in place to recoup that money should your card get stolen or there are fraudulent transactions that take place. When you spend on a debit card, it goes directly off your account and that's your cash gone out the window. It is quite difficult to get that back. Obviously, you have to prove it, but it isn't necessarily insured. So that's why it's better to spend the bank's money. It's just safer. Now, we've understood the different ways banks can make and spend money when it comes to credit cards and the benefits. I'd like to present a few interesting facts about credit cards to give us this global view of the credit card economy in different markets. So starting with the United States, there is on average 3.84 cards per adult, which is the highest spend per capita. There is 631 million active credit card accounts. And as of Q2 of 2025, the total credit card debt reached a record of $1.21 trillion. So we can see that credit cards are particularly popular in America with about more than 3 cards per adult. So if we want to unpack why this is the case, what makes credit cards so popular in America, there are a couple of things that we can look at. So number one, there is this widespread acceptance of credit card culture in America. It is assumed that a credit card is the default payment method almost everywhere you go, from big retailers to small stores to online stores. It's just accepted that someone will have a credit card and they will need to pay with it. The rewards and perks are also really generous, and they are tailored to keep customers swiping on said cards. The rewards and the loyalty programs work well for customers. There's much easier access to credit in the US. Banks make it quite quick and simple to get approved. Not only is it easy to tap and swipe, it's also easy to sign up for a new one. And that fuels the spending power behind credit cards. Then there's this additional layer that makes credit cards so appealing in the US, and that is this perceived affordability of a credit card. And I fell victim to this at the beginning of the year, because psychologically it feels better to pay for something later or in small amounts over time, rather than making a big purchase and watching that money leave your account straight away. There's this idea that it's somehow cheaper. Even if you pay in installments, you are most likely paying interest, but because you are paying a smaller amount over time, it feels cheaper. I had to make a big purchase at the beginning of the year. I had the cash to do it. I was capable of paying for it in full, but for some reason it just felt too taxing. I was emotionally attached and I did not want to watch that money leave my account straight away. So I paid for it in installments. Luckily for me, my installments were interest-free. At the time, my mother was my credit facility. This perceived affordability is a major factor that drives credit card applications and issuance. Moving beyond just this view that a credit card is amazing and you don't have to pay for anything because it's someone else's money. Understanding that credit cards, when you use them well, and it's not just viewed as this kind of debt machine, it is used as an alternative to a debit card where you still spend within your means, you don't go over the limit, you don't spend more than you have, you can make credit cards work really well for you. And I think the US has that mindset towards credit cards and they have that culture ingrained within them. On the other hand, if we turn to the global markets, it's different. So looking, obviously we have a South African audience. So in South Africa, credit cards are offered by all the major banks, including FNB, Standard Bank, Nedbank, Absa, Investec, all of them. And while credit cards have not always been the most popular form of transacting, there has been a surge in uptake with a 43% year-on-year increase in new credit card applications. One of the reasons why credit cards haven't always been the most popular form of transacting, or why a lot of people don't necessarily have or use a credit card, is possibly income disparities and this preference for cash. So when you come from a kind of lower income background, the bank views you as risky and they will typically charge you higher interest rates because they can't guarantee that you will pay the money back. You don't necessarily have a steady or stable income. So there's limited access to these mainstream banking services. And then there's financial exclusion. Not everyone has a bank account, nor can they then access the credit card, and it's often too expensive. But beyond that, cash is viewed as something that is universally acceptable in both formal and informal economies. So it is the preferred payment method. But we're seeing a change as card machines become more available everywhere. I know anywhere I go, I'm guaranteed to find a Yoco machine. So that's changing the kind of uptake in credit cards. Then secondly, looking at Europe. In Europe, debit dominates, but credit card use is growing within e-commerce. Both Visa and MasterCard have seen a growth within Europe, with Visa seeing a 6 to 7% increase and MasterCard seeing a 12 to 15% increase. I see Jason said a comment. We are cash-free establishments at the moment, which is much safer. I was at a coffee shop that had to shut down because they didn't have a card machine. I think there was no electricity working. So they had to close for the day because they don't take cash. And that's bad business. So anyways, looking back at Europe, debit dominates, but credit use is growing. The reason debit in Europe dominates is the exact opposite of the American view of credit, which is there is a strong consumer preference for spending within available funds. There's this cultural caution and aversion towards debt. Credit card debt is so terrible. On top of that, there are also more regulatory measures that make credit less aggressively marketed towards customers as opposed to in the US. So there's more of a cultural aversion towards credit cards in Europe. Now looking at Asia Pacific, credit cards remain the dominant payment method in the region, accounting for 58% point of sale transactions. But that said, digital wallets account for 15% and they are growing. Credit cards still hold a strong lead thanks to kind of rapid urbanization. There are more point of sale transactions happening. And there's also more established loyalty programs that are similar to the US. However, the region is seeing fast growing mobile wallets and mobile money, particularly in markets like China and Southeast Asia. And what this could end up doing is eroding the kind of traditional credit card dominance within the region. Now turning to kind of like a closing interesting fact, looking at emerging markets. So card issuance is rising, more people are signing up for cards, but activation and usage are lagging behind. That is why we are here today to present how to activate credit cards. Activation is the problem for banks. So looking at why activation stalls. So number one, there is a preference for alternative payments method. As I've mentioned, in emerging markets and lower income segments, consumers are increasingly preferring mobile money and digital wallets over traditional cards, largely because these alternatives are more convenient, they're a lot more easily accessible, and they often have lower fees attached to them. So they make them a little bit more, these alternatives are a lot more appealing to then going through the traditional process of getting issued a credit card and getting your credit approved. Many customers are cautious around incurring debt due to the kind of maybe limited disposable income or the cultural preference. I have this view that once you get the credit card and you start tapping on it, you don't stop. It never ends, and it's just a portal into debt. And obviously I'm working to change that view, but nonetheless, that is a potential reason as to why a lot of people would be kind of hesitant to activate their credit cards for fear of high interest rates and debt accumulation. Then we also have unfamiliarity with the activation process. Activation steps can be confusing or inconvenient. And it's important to mention here that these are all challenges for the banks as to why activation stalls or doesn't happen. That's not to say that they aren't aware of this challenge and that there aren't procedures in place to help mitigate this. An interesting one here with the unfamiliarity of the activation process is that Jess and I were talking about it today. When she got issued her credit card, her bank phoned her every single day to say, we are going to guide you through the application process on your app until your card is activated. So there is a process to activate the card, and banks obviously want to drive that activation as early as possible. But unfortunately, for a lot of banks, the customer might not fully understand how or where to activate, say, credit card. So, Jesse.
I just wanted to add on that as well. It was great. It's very personalized what they did. They were phoning me the whole time. The amount they were paying and the call agent to phone me to then press a single button on the app seemed quite disjointed.
Yeah, that is kind of, it relates back to that cost that I was talking about, the cost to get you to activate. We will get into a bit later as to why banks really want you to activate your card. There's a lack of a clear instructional understanding for customers where, how, and when to activate it through different channels, whether it's via phone call, an app, or on a website. There's also potential of a delayed activation process. Cards take time to deliver. Sometimes when you sign up for your credit card, it's this like instant gratification that you're looking for. You get approved, you get issued the card, and then when it takes a while to deliver, the excitement goes away, and it's just viewed as this, inconvenience. I now need to activate it, and it just goes back into the drawer. There are cultural and behavioral factors. So sometimes there's a deep-rooted preference for cash. Consumers may feel more comfortable with the tangible cash that they have. You can be enthusiastic and sign up for the credit card, but you may fall back to what's convenient and comfortable. Now we understand these are reasons why activation may stall. I'd like to bring our attention to two important problems within a bank. There are inactive credit cards, but there are also dormant credit cards. These are two different challenges that require two different approaches behaviorally. A dormant credit card is one that has been activated, but the person has gone through the hassle of having the card issued, they've activated, they've potentially made their first transaction or made a couple more, but now the card has fallen into the back of the wallet or the drawer and it's forgotten, it's no longer being used. Inactivation is very different. The person has gone through the issuance, the onboarding process, but they haven't made that first transaction. The card has never been activated. These are two entirely different challenges and require two different approaches from a behavioral perspective. Activation is harder because it requires encouraging someone to take that first step that they may not have ever taken. It means equating them with unfamiliar territory and encouraging a first step, which is always harder than someone who is already familiar with the process. In the case of a dormant user, they're easier to re-engage because they have already activated the card. They've gone through the inconvenience of it all. They are familiar with the process. They know how to tap their card. They just need that re-engagement that excites and creates a sense of novelty within the product. So these are the two different challenges and why they require two different approaches. But now, obviously, for this talk, we are looking at specifically inactive or cards that have never been activated. And I want to now unpack the kind of hidden cost, why it is a major problem for banks to have a large base of inactive credit cards. Number one, these are issued cards that have never been activated. And the main reason that they are such a problem is because they drain resources without ever generating revenue. So looking at why it's costly. Banks will go through the whole issuance and onboarding. They will acquire customers, that has costs attached to it. They will then process the customer, get them onboarded, that has costs attached to it. And then they will have to open the account and manage that account, and that has costs attached to it. I was reading the Chase annual report a few weeks ago, and what they mentioned about maintaining and managing just basic transaction accounts, not necessarily a credit card account, it costs them about $250 to manage the account, of which $150 is a fixed expense. So irregardless of whether or not that account is earning the bank money, they have to pay that to maintain the account. For a credit card account, it might be slightly more given the kind of fraud and insurance that it's attached and the safety procedures that are attached to monitoring this account. So the bank goes through this process, they pay their dues, but the card is never activated, meaning they never earn interest, they never earn the interchange fees, they never get the opportunity to build rapport with their customers and upsell and cross-sell more products. Those funds are never recovered. They still have to pay the account fees, they still have to manage the account and pay the fraud monitoring and the compliance, regardless of whether you spend. And then what this also leads to is a lower return on investment in marketing. If you put out a whole campaign to get more customers, you acquire them, but they never activate, you don't make money. It is ineffective and it's seen as a waste. So it clearly drains the bank's resources, and this is a major problem. Now, how do we solve this problem? If you have been to one of these meetups before, I'm sure you are no stranger to the slide that I'm presenting now, but if you are new here, what we are looking at is the stages of the customer lifecycle where you can apply spend personality and the different ways that you can engage with your customer within these stages. Naturally, because we are talking about credit card activation, we are going to be looking at the activation space. What's important to note here is that for each credit card customer that signs up for a credit card, banks will cycle within this between the engage and activation space, and they will move between that, going from onboarding to encouraging that first use and activation. So given that banks want to drive activation, how did they do this? What are the tactics they can take to drive activation? Number one, no engagement. Silence is an option. They can issue the card, deliver it, and say, go forth and prosper, and they don't have any measures in place to get the card activated. If they do have another step to encourage a customer to spend on their card and make that first transaction, it may be an SMS, an email, or a notification via the app. This nudge is often fairly generalized and standard. It's something like, your card is ready to use, start spending today. Maybe if your bank adds in a hello first name, your card is ready to use, activate today. As a layer of personalization, but as we've discussed in a lot of our meetups, hello name is not a form of personalization. It's just essentially shouting your customer's name at them. There's no personalization or behavioral insight. Once the bank has sent out the message, they can also add an incentive to it. Rewards and incentives do encourage people to take action. The problem is these rewards and incentives are often one size fits all and communicated in a very generic way, whether it's cashback, bonus points, partner rewards, or discounts on flights. It's all communicated the same. There's also a limited timing strategy, so messages sent in fixed intervals, day 1 when the card is issued, day 7 as a reminder, and day 30, and then it kind of ends there. What this engagement strategy and timing misses is crucial decision-making moments. It misses the opportunity to recognize the customer's ready to activate, let's remind them now, or the customer's on their phone looking at their banking app, misses these moments where a customer is ready. And what it does as an alternative is it puts the message out there, the customer either never sees it or they see it at a time when it's inconvenient. And again, it is ineffective. So when we look at these tactics and we see that they aren't working, we want to get down to the heart of why that is. Why is generalization and personalization not working? Why aren't these messages working? But why do banks still follow with these basic general messages? And the main reason is because banks are missing out on the opportunity to better understand their customers. When you want to connect with someone, make a recommendation or an offer, you need to speak with them. You mustn't speak at them. Don't shout at them. And by not understanding how your customer likes to be communicated with and not understanding what resonates with them is a major issue for banks. For banks, it is moving away from demographic-based segmentation as the spearhead behind personalization. So I'm sure we are familiar with demographic-based segmentation. It is essentially when you group customers by demographic traits such as their age, their gender, their race, their income level, location, occupation, these traits. And how a bank would use it is to say people born between this date, in this case millennials, they want and value experiences, let's match rewards that are flight deals or eating out experiences, things like that. High income earners must prefer luxury perks, so let's offer them the best rewards that come with the best travel deals, such as airport lounges. But the problem with using demographic-based segmentation as your main form of personalization is that it views customers who are actually very different as the same person. When we look at the example over here, we have King Charles and Ozzy Osbourne. They are essentially the same demographic. Shame Ozzy Osbourne, may he rest in peace. They are essentially the same demographic. They're both male, born in the UK, born in 1948. They lived in castles, one lived in a castle, and they were both wealthy and famous. They are viewed as the same by the bank. This is the same customer. We need to communicate with them in the same way. But I think it is a pretty safe assumption to make that Ozzy Osbourne and King Charles are actually very different people in the way they behave and the way they spend their money. So how do we look at these two customers that are of the same demographic? How can a bank reimagine them? Behavioral-based segmentation. So what if banks could see these customers as different spenders despite being of the same demographic? Ozzy Osbourne is fairly spontaneous and impulsive. He's a rock star, so he may fly to Los Angeles on a whim because Black Sabbath recorded better in California. King Charles, I know, on the other hand, from royal documentaries, he's quite meticulous, structured, and he likes everything done a set way. When he tours the Commonwealth or goes on holiday, there is a strict itinerary, and he sticks to it, usually planned way in advance. So we can see that they behave differently. We can also then make the assumption that they probably spend their money differently. King Charles may be ritualistic, long-term orientated, and he definitely spends on good tailoring and suits. And he's a big fan of horses, so there's probably a lot of horse veterinary bills. Ozzy, on the other hand, is probably impulsive. He enjoys in-the-moment purchases. What's that? Short-term gratification. I learned that he had a lot of pets, so he probably spent on pet gifts and things like that, as well as personal medical bills. So as we can see, these are two very different people when we take a look at their behavior. Now, what's the tool for banks to understand their customers from a behavioral perspective and better understand them beyond demographics? The answer is spend personality. Spend personality is a behavioral segmentation method that categorizes customers based on their spend patterns, the rhythm, and the purpose of their spending. It's not just what they buy, but how and when they spend their money. So it's important to note here that what this module does, the spend personality module, it augments customer data. So for banks, it is equally important to know that your customer is female, they are a certain age, of a certain income, and they live in a certain location. It is now vital to add more information to that from a behavioral perspective. Banks should know that customer X, who is female, and they spend in a certain way, but another customer, 591, is male, and they spend in the same way. It's important to note here that we augment customer data. This module reveals the lifestyles, values, priorities, and decision-making styles by looking at where money flows. So does it go to travel, leisure, home improvement, essential categories, discretionary categories? Then it also looks at the energy behind the purchase. Is it impulsive or deliberate? And then the frequency of transactions. The spend personality algorithm runs in our product, the prediction platform, on a bank's or customer's transactional data to make behavioral-based predictive customer segmentation. And what's important to note here is that unlike demographic segmentation, which would assume that people of the same age or income behave alike, spend personality shows through behavioral evidence that customers of two identical demographics, in this case, King Charles and Ozzy Osbourne, can behave completely differently, and they can have very different spending patterns. Because they behave differently and view spending differently, they require different engagement approaches, offers, and products. So now we've spoken about spend personality, but what are the spend personalities? Well, I want to look at the key four today, the core four: intentional, industrious, experiential, and enthusiastic. Intentional spenders are generally slow to action and prefer more information. They are more likely to spend on the same number of categories in the same way for the same amount from a month to month, on a month-to-month basis. They spend on essentials like insurance, medical aid, and stuff for that extra layer of security. Then we have industrious spenders. And these spenders prioritize essential spends. So an essential spend category is, what we need to live, to be human. It's food, water, electricity, a home, clothes, standard, things like that. Those are essential to be a human. Your discretionary spends are everything above and beyond that. So unlike the intentional spender who only spends on the essentials, the industrious spender will occasionally spend on the discretionary item. They know how to have a little bit of fun here and there. Just as an interesting fact, the bulk of transactors fall within this industrious space. A good way to think of them from a kind of spend personality perspective is to think of them as working parents. You spend on what is needed for your family, what's essential, and then you can go above and beyond that. Then we have experiential spenders. As the name says, they spend on experiences. Anything from travel to movies to shows to bungee jumping, go-karting, surfing, whatever it may be. They spend on experiences. And interesting fact as well, most people who are experiential spenders are typically in their 20s or in their uni years. They exhibit these tendencies of an experiential spender because it's not about going to lectures. The uni experience is about what you do outside of that. Now we have enthusiastic spenders. These are excited spenders and they spend on a large number of categories and aren't bound to a particular category. They will have very different networks on a month-to-month basis and they're quite large. They like things and they like something that excites. So these are our different spend personalities and the different ways that we can understand customers, or a bank could understand their customers. So when we look at spend personality clusters, it's these categorical engagements beyond the common spends that indicate the customer spend personality. So if you look in the middle, I don't think you can see, my cursor won't move, no. But there's those green dots in the middle. Those are the essential spends that are all common. We all need to spend on food, housing, water, and electricity. But it's the categories beyond that, the yellow dots, that showcase a person's spend personality. So it analyzes the categories, but then also the how and when customers spend. And what this does is it creates a dynamic behavior-driven profile. Not all spend personalities respond to the same message. They respond differently and they value different aspects of a message. So when we look at the tone, the timing, the structure, and the channel, different personalities respond differently. So the old way, the old demographic-based way, inactive cardholders would all receive the same message regardless of what truly drives them. So the standard message could be, make your next purchase count, activate your credit card now. If you really want to prompt more action, you can add an exclamation mark or even a smiley face. But if we adopt the spend personality approach, the collective of inactive cardholders would be segmented into up to 6 spend personalities. They would receive a tailored nudge that speaks to their values. So in the case of the intentional spender, we've got to activate your card and start earning rewards that fit your goals. Every purchase can grow your savings, fund your next big step, and support what matters most. And what's important to note about this message is that it is a calm message tone that encourages thoughtful action and framing. Intentional spenders like to be informed and they like to make the decision on their own. The CTA is never something impulsive like activate now, grow today, do something in this moment. They want to make that decision in their own time. In contrast, when we look at the experiential spender, their message does have the words, activate your card today and enjoy instant perks. Entertainment and adventures are waiting to happen. So when we look at the wordings and the categories included within this message, it's very different. It talks about adventure and travel and things that appeal to the experiential spender. The style of the message is upbeat and it's got a forward-looking tone. And the CTA should be immediate. It should have the word now or today. Now, if we add an additional layer and move into matching rewards to motivation, because a message is great. A message wrapped in a way that resonates with customers is important. But another kind of way that we can prompt action is adding an incentive to that message. This approach can also be used for dormant cardholders. Spend personality can solve this challenge as well. Dormant cardholders are familiar with the process of activating a card, or they've already activated their card, they know how to use it. It's now just encouraging that fresh engagement and action and that sense of novelty, and reward is a great way to do this. Looking beyond just spend personality and at the prediction platform as a whole, rewards can be made on a per customer basis. When you use the prediction platform and you come to understand, this customer mostly spends on these categories, they travel a lot, they fly a lot, they enjoy the airport lounges, whereas this customer enjoys electronics and they shop at the iStore. You can come to understand your customers and then you can match rewards to that customer. But what's also important to note here is that Just because an intentional spender doesn't necessarily value traveling the same way an experiential spender would, it doesn't mean they don't fly. It doesn't mean they don't have to get on a plane to either visit family or travel for work. So what can be done here when you match a reward to a motivation is you can offer the exact same reward, one size fits all reward to every spend personality, but you can frame it in a way that resonates with said spend personality. A flight deal or a discount on flights would be reworded and written in a different message to an intentional spender as it would to an experiential spender, despite the fact that it is essentially the same reward. The power of making an activation nudge or recommendation comes in delivering the reward wrapped in this nice message at the right time. That is where we also bring in the full view of the module spend personality with the prediction platform equals the full solution. The recommendation can be made in a message style that matches the spend personality, can also be made with an incentive. But that's only half the battle, because making the right offer at the right time is also important. If your customer never sees the message or they see it at a time that is inconvenient, it's wasted effort and budget. With a prediction platform, it automates the engagement timing of these messages on a per customer basis. The system can learn, if we're talking specifically digital interfaces such as an app, it can learn when a customer logs on and how they engage or interact using something known as interaction science with that digital interface. So, for example, I, as an intentional or an experiential spender, can log onto my app and I tap around. I can stay on there for a while. I can have, if we look at my seconds per visit, I can be on there for a long time, but I never actually take any actions. I'm just exploring what my app has to offer. A different spender may come on and they have a clear purpose. They log on, they click, cards, navigate, and complete their task. There is a limited time window to engage with that customer. They have come in for a purpose and they want to complete that action. Your message needs to be delivered at that time and match that purposeful engagement. And that's obviously where the messaging style would come in. Using the full solution, banks can make the right offer to the right customer at the right time, every time. Now that we've unpacked the different applications, I want to look at how do you configure the spend personality module in the prediction platform. Banks can create both static and dynamic models powered by behavioral AI, real-time interaction data, and experimentation. The bank would connect their transactional, engagement, and contextual data. They would then use the spend personality algorithm for existing customers. In my case, I am an existing customer and I've now opened up a new credit card. They would score on my known data and transactions. They would then score on said customers to get their spend personality. So, I could be experiential, industrious, or intentional. You can also use the spend personality model for new customers and the spend personality dynamic model for all customers. Now, once you've scored and each customer has been assigned their spend personality score, you can view spend personality data on a per customer basis using the accompanying dashboards and the in-workbench data view. Now that we understand, where each customers are segmented into or their spend personalities, we now want to generate the message. We want to create the recommendation that will drive activation, and you can use generative capabilities for that. For each spend personality, we have a messaging GPT. Once you've got the message, you configure the recommendation system to deliver that activation offer. Then you can configure dynamic experiments to test the messages, to see what works and what doesn't. With the hope of configuring that, you get an activated card. The customer should activate, but the battle isn't over yet. You want to continuously deploy real-time tailored recommendations based on their behavior. You want to keep them engaged. You want to retain them. That's the next phase of the customer lifecycle, where you can use spend personality, and it's about keeping that customer active and learning what works, what doesn't, and adapting in real time. So that is how spend personality would be configured on the Ecosystem AI prediction platform. We've covered credit cards, we've covered spend personality and the application of it all, and now we want to look at the impact of the measurable wins. So number one, if you are inactive cards, you make the right offer at the right time to the right customer, they're going to activate and start spending because it resonates with them. There's also that faster spend velocity, and your customers start transacting a lot more frequently earlier on. We always talk about making money, saving money, and protecting money. When you have more active cards and more active spenders, you get higher non-interest and interest revenue. Lastly, there's reduced marketing waste. When you adopt an approach that is behaviorally backed, so data backed, it is precise, accurate, and you are more likely to see a return on it. So that is everything there is to unpack about credit cards and how you can drive activation using spend personality. There is still time for questions, so I will be taking questions, but I do also want to pose a question to maybe spark some conversation. If you had signed up for a credit card, you've gone through the hassle of submitting your documents and getting approval, you've got the card and you don't activate it, what can a bank do to encourage you to activate your card? Ryan, yes, could you please go ahead?
Hello. First of all, that is a fascinating presentation. From my side, I am new here, but I did have a question in my head. How long, or what is the period of data that you would need to actually categorize a person into one of those 6 categories that you showed there? What is the amount of data that you'll need per person?
Hey Ryan, yeah, maybe I can just give you a glimpse of that. We determine it dynamically based on an entropy score. So what we do is we run an analytic across all the transactional data and calculate if we will be able to obtain enough evidence to give a reliable score to the entire population. Otherwise, if there is, let's say 10, 20 or 30% of your customers that are incredibly active, whatever the number is, we take that set and there's already a predefined static model parameters, so hyperparameters already available, that you then train a model on the customers that you know well and getting an understanding of what good looks like. And then the next time you want to score that customer, you run what we call a network selector so that you can do an experiment with dynamically selecting based on a dynamic algorithm. And then the model gets scored and you then generate basically evidence over time that will then become reliable on the customers that you're busy activating. The idea is that if you have enough demographic attributes about a customer, understand how many products they have, where they live, when they spend, the category, the distance they travel between spend, we can use all of those features to make it fairly reliable. As you get enough evidence, and our score tells us we have enough evidence, we run the algorithm directly.
Fascinating. Thanks, guys. Thank you.